Picture this. It's 2007. The world is a giant party fueled by cheap credit and even cheaper mortgages. People are buying houses they can't afford with money they don't have. Wall Street is intoxicated by something called mortgage-backed securities, bundles of loans packaged and sold as investments. Let's take a peek behind the curtain of Wall Street, where financial wizards are juggling complex financial instruments like credit default swaps and collateralized debt obligations. These instruments, meant to manage risk, have become tools of speculation, creating a house of cards built on mountains of debt. Banks are leveraged to the hilt, borrowing heavily to make even riskier bets. The music is still playing, but the floor is about to collapse, and when it does, the aftershocks will be felt across the globe. Remember those affordable mortgages everyone was snapping up? Many were subprime loans, handed out like party favors to borrowers with shaky credit. Banks weren't just giving out loans, they were incentivized to dish them out like free candy. The more loans they made, the more money they seemingly made. These subprime mortgages, bundled together, became the toxic ingredients in those mortgage-backed securities. Meanwhile, nobody seemed to question why house prices kept going up. It was like watching a game of musical chairs where everyone believed there would always be a seat available. Wall Street saw these mortgage-backed securities as a golden opportunity. They bundled and repackaged them into even more complicated instruments, like collateralized debt obligations, CDOs. These CDOs were then sliced and diced into different tranches, each with varying levels of risk and reward. The riskiest tranches, packed with those subprime mortgages, were the first to go bad. To make matters worse, credit default swaps, CDSs, entered the scene, essentially insurance policies on those mortgage-backed securities. The financial system had become a giant casino, with everyone betting on the housing market. Now, in this financial circus, you can't forget the ringmasters, the credit rating agencies. These supposedly independent organizations were responsible for assessing the risk of those complex financial instruments. Instead of waving the red flag on those risky mortgage-backed securities, they gave them glowing ratings. AAA, the gold standard. These ADLA ratings gave investors a false sense of security. The stage was set for disaster. The music was still playing, but the musicians were starting to pack up their instruments. Remember those adjustable rate mortgages with the low introductory rates? Well, those rates were about to skyrocket. As interest rates rose, borrowers started defaulting on their mortgages. The cracks in the housing market were becoming impossible to ignore. Housing prices started to decline, and those mortgage-backed securities began to lose value. Wall Street continued to churn out those complex financial instruments, fueled by greed and denial. Little did they know, the next song on the playlist was a recessionary ballad. Remember those risky mortgage-backed securities everyone thought were as good as gold? Yeah, not so much. As housing prices plummeted, those securities transformed into financial ticking time bombs. Investment banks like Lehman Brothers found themselves drowning in a sea of toxic assets. Panic surged through the financial system like a tidal wave. Banks, terrified of lending to each other, slammed the brakes on credit. Lehman Brothers filed for bankruptcy, sending shockwaves across the globe. The financial crisis quickly jumped from Wall Street to Main Street and then went global. Stock markets around the world plunged into freefall, erasing trillions of dollars in wealth. Credit, the lifeblood of the global economy, dried up faster than a puddle in the Sahara Desert. Businesses, starved for cash, were forced to lay off workers, adding more fuel to the economic fire. The world watched in disbelief as the once mighty global economy teetered on the brink of collapse. It was a stark reminder that in the interconnected world of finance, trouble in one corner could quickly spread like a virus. Foreclosures skyrocketed as homeowners, unable to keep up with their ballooning mortgage payments, were forced to hand over their keys. Businesses, large and small, struggled to stay afloat amidst the economic storm. The credit crunch made it nearly impossible to secure loans, forcing many to close their doors for good. The unemployment rate soared, leaving millions of people jobless and struggling to make ends meet. The American dream seemed to be slipping out of reach for many. The financial crisis had exposed the deep flaws in the system, leaving countless individuals and families struggling to pick up the pieces. With the global economy on the brink of collapse, governments around the world faced a stark choice: intervene on an unprecedented scale, or risk a complete financial meltdown. In the United States, the government stepped in with a massive $700 billion bailout package known as the Troubled Asset Relief Program, TARP. Central banks around the world also slashed interest rates to near zero and implemented quantitative easing programs. These interventions, while controversial and far from perfect, helped to stabilize the financial system and prevent a complete economic collapse. The patient, while still very much in recovery, was at least showing some signs of life. The question now was, how long would the recovery take, and what scars would this crisis leave behind? Picture this. The global economy is bleeding out, and governments are frantically trying to stop the hemorrhage. The US government, armed with the Troubled Asset Relief Program, TARP, injected billions into struggling banks. Meanwhile, central banks around the world slashed interest rates to near zero, making borrowing cheaper. The goal was to stimulate lending and kickstart the economy. These emergency measures, while controversial and far from perfect, helped to stabilize the financial system. Think of it as a financial tourniquet, stemming the bleeding but not quite healing the wound. The financial crisis wasn't a sprint, it was a marathon, and the road to recovery was long and winding. Public outrage grew as taxpayers, forced to foot the bill for Wall Street's recklessness, watched CEOs walk away with hefty bonuses. Governments grappled with the challenge of stimulating economic growth, while also reining in the excessive risk-taking that had caused the crisis. The recovery was slow and uneven, with some sectors bouncing back faster than others. It was like watching a garden grow after a drought, with some plants springing back to life while others withered and died. In the aftermath of the crisis, governments around the world vowed to never again let such a disaster happen on their watch. The United States passed the Dodd-Frank Wall Street Reform and Consumer Protection Act, a massive piece of legislation aimed at overhauling the financial industry. These reforms aim to increase transparency, limit excessive risk-taking, and protect consumers from predatory lending practices. Whether they were enough to prevent another crisis remained to be seen. The debate over financial regulation continued, with some arguing for even stricter rules, while others cautioned against stifling economic growth. It was a delicate balancing act, like trying to tame a wild animal without killing it. The 2008 financial crisis, though seemingly a distant memory, left lasting scars on the global economy. Public trust in financial institutions, once considered pillars of stability, was shattered. The crisis also fueled a debate about income inequality, as the gap between the haves and have-nots continued to widen. The 2008 financial crisis served as a stark reminder that the global economy is a complex and fragile ecosystem, prone to shocks and imbalances. It underscored the need for vigilance, regulation, and a healthy dose of skepticism when it comes to the promises of easy money and endless growth. So, did we learn anything from the 2008 financial crisis? Well, that depends on who you ask. Some would say we dodged a bullet, implemented some much-needed reforms, and emerged stronger and wiser. Others might say we slapped a band-aid on a gaping wound, patted ourselves on the back, and went right back to our old habits. Sure, there were attempts to rein in Wall Street, increase transparency, and protect consumers. The Dodd-Frank Act, a behemoth of a bill, promised to do just that. But let's be honest, it's like trying to teach a dog to do calculus. You might make some progress, but at the end of the day, the dog's still gonna chase squirrels. The truth is, the financial system is like a giant game of whack-a-mole. You try to plug one hole and another one pops up somewhere else. And let's not forget the human element, the greed, the short-sightedness, the belief that this time it's different. Spoiler alert, it rarely is. So, did we learn our lesson maybe? Did we learn enough to prevent another crisis? Only time will tell. But one thing's for sure, the 2008 financial crisis served as a stark reminder that when it comes to the world of finance, vigilance is key. Now let's talk about blame. Everyone loves a good blame game, especially when it comes to financial meltdowns. It's almost like a sport, with each player trying to dodge responsibility and pass the buck to someone else. So, who were the usual suspects in this global game of financial hot potato? Let's break it down. First up, we have the Wall Street wizards, those masters of the universe who conjured up those complex financial instruments with names that sound like they were invented by a team of caffeinated toddlers. These financial products were so convoluted that even seasoned investors had trouble understanding them. They assured us it was all safe and sound, right up until it wasn't. Their confidence was contagious, and many people bought into the illusion of security. Next, we have the credit rating agencies, the referees who were supposed to keep the game fair but instead spent most of their time schmoozing with the players and collecting their hefty fees. They were the gatekeepers, but they left the gates wide open. They handed out AAA ratings like participation trophies, seemingly oblivious to the fact that the entire game was rigged. Their ratings gave a false sense of security to investors who trusted their judgment. And let's not forget the regulators, those supposed watchdogs who were caught napping on the job, perhaps blinded by the dazzling lights of Wall Street, or maybe just overwhelmed by the sheer complexity of it all. They were supposed to be the guardians of the financial system, but they failed to see the warning signs. They were supposed to be the adults in the room, but it seems they were too busy playing with their thumbs to notice the house was on fire. Their inaction and lack of oversight allowed the crisis to escalate. The blame game could go on, but the bottom line is this. It was a collective failure, a perfect storm of greed, recklessness, and regulatory oversight. Each player had a role in the unfolding disaster, and their combined actions led to a catastrophic outcome. And unfortunately, in the aftermath, it seemed like the people who were least responsible for the crisis ended up paying the highest price. Ordinary citizens lost their homes, jobs, and savings, while many of the key players walked away relatively unscathed. Throughout history, financial crises have followed a predictable pattern: boom and bust, rinse and repeat. It's like watching a hamster on a wheel, running and running but never actually getting anywhere. So, is another crisis inevitable? If history is any indication, it's not a matter of if, but when. Human nature, with its insatiable appetite for greed and its remarkable ability to ignore warning signs, plays a starring role in this never-ending cycle. We convince ourselves that this time it's different, that we've cracked the code to endless prosperity. We forget, or perhaps choose to ignore, that gravity always wins in the end. Financial innovation, while often touted as the key to progress, can also be a double-edged sword. It can lead to greater efficiency and growth, but it can also create new and ever more complex ways to gamble with our financial futures. It's like giving a toddler a chainsaw and expecting them to build a treehouse. It might work out, but it's probably not the wisest course of action. So, buckle up, Buttercup, because the roller coaster ride of economics is far from over. There will be ups, there will be downs, and there will be moments where you'll question why you decided to get on this ride in the first place. As we've journeyed through the wreckage of the 2008 financial crisis, one thing has become abundantly clear. The world of finance is a dangerous and often unpredictable place. It's a world where fortunes can be made and lost overnight, where complexity can be used to obfuscate risk, and where the rules of the game seem to change with the tide. So, what's the takeaway for the average person? Simple. Stay vigilant. Don't be afraid to ask questions, to challenge assumptions, and to demand transparency. Remember, when it comes to your financial well-being, ignorance is not bliss. It's an open invitation for trouble. Educate yourself about the financial system, understand the risks and rewards of different investments, and don't be afraid to seek professional advice when needed. Remember, knowledge is power, especially in the world of finance. The 2008 financial crisis was a wake-up call, a stark reminder that the global economy is a delicate and interconnected ecosystem. It's up to all of us to learn from the mistakes of the past and to demand a more stable, transparent, and accountable financial system for the future. Because when it comes to the global economy, we're all in this together. Stay informed, stay vigilant, and maybe, just maybe, we can avoid repeating the mistakes of the past. If you like our video, please hit the like button. And also don't forget to subscribe to our channel. Thanks for watching.